Hello everyone, and welcome. I'm excited to have you here today. Today, we're diving into a comprehensive guide to Subledger and posting group management. Our focus will be on ensuring financial accuracy and efficiency through proper configuration and best practices. Over the next few slides, we'll explore key concepts, strategies, and tips to help you optimize your financial processes. Let's get started. Let's start by discussing what subledgers are and why they are so important. Subledgers are essentially detailed ledgers that track specific transactions for particular accounts, like bank accounts, accounts payable, and accounts receivable. By maintaining these detailed records, we can ensure greater accuracy in our overall financial data. One of the biggest advantages of using subledgers is that they significantly reduce the time lost during reconciliation processes. Instead of sifting through massive amounts of data, we can directly access detailed transaction information, which streamlines our workflows. Additionally, subledgers help us avoid costly errors in financial reporting. When transaction details are precise and well-organized, the chances of mistakes decrease, leading to more reliable reports. Overall, subledgers are vital for maintaining financial accuracy. They provide the granular detail needed to produce correct and trustworthy financial statements, supporting our goal of transparent and accurate financial management. Let's take a closer look at the key types of subledgers and how they fit into our overall management system. First, we have projects, which are essential for managing costs, sales, and work in progress for specific projects. This helps us stay on top of project profitability and resource allocation. Next is fixed assets, where we track acquisition, depreciation, and disposal, ensuring our asset records are accurate and up-to-date. Then there's inventory, which records stock movements and valuations, giving us clear visibility into our stock levels and value. Moving on, accounts receivable focuses on monitoring customer invoices and receipts, so we can effectively manage cash flow from our clients. Accounts payable handles vendor invoices and payments, helping us maintain good supplier relationships and stay organized. Lastly, bank accounts track all cash and bank transactions, which is vital for maintaining accurate financial records and cash management. Connecting all these types of subledgers helps us streamline our financial processes and supports effective decision-making across the organization. Let's take a closer look at configuring posting groups in Business Central. On this slide, we see that these groups are set up on different cards, specifically the customer card, vendor card, and bank account card. These groups are essential because they determine how transactions are posted to the correct general ledger accounts. For example, the customer posting group is assigned directly on the customer card, while the vendor posting group is set on the vendor card. Similarly, the bank account posting group is configured on the bank account card. The main purpose of these posting groups is to control how transactions flow from subledgers, like customers, vendors, or bank accounts, into the general ledger. This setup ensures that every transaction is categorized accurately, which is vital for reliable financial reporting. Throughout our presentation, you'll see how understanding and properly configuring these groups helps maintain data integrity and simplifies the accounting process. Let's take a closer look at Slide 5, which focuses on the comprehensive guide to subledger and posting group management. This slide highlights how these tools help us map inventory and asset transactions accurately to the general ledger. This is crucial for maintaining correct financial records and ensuring our financial reports are precise and reliable. Now, the purpose of posting groups is central here. When we assign a posting group on the fixed asset card, we're essentially telling the system how to handle asset-related transactions. This helps us manage asset accounting more effectively and ensures that every asset transaction is correctly mapped to the right part of the general ledger. Similarly, for inventory, we assign a fixed asset posting group on the item card. This categorizes stock items properly, which is vital for accurate ledger postings whenever inventory transactions occur. To summarize, these inventory and fixed asset posting groups are key tools that support our overall goal of accurate financial management. They help us categorize and map transactions correctly, which in turn supports reliable reporting and compliance. This is all part of our broader effort to streamline financial processes and maintain data integrity across the system. Let's dive into Slide 6, where we explore the comprehensive guide to Subledger and posting group management. First up, project posting groups and general posting setup. These are crucial because they tie together customers, vendors, and items, creating a seamless flow for sales, cost of goods sold, and other financial transactions. Essentially, they help us ensure that our accounting remains integrated and consistent across the board. Moving on to the general posting setup, this is all about managing how project-related transactions are posted to the ledger. Think of it as the control center for WIP, costs, and sales entries, making sure everything lands in the right place. Now, focusing on project posting groups, they serve as a way to categorize and manage these transactions more effectively. By setting up these groups, we can streamline the posting process, improve accuracy, and gain clearer insights into project financials. Connecting these points back to our overall theme, effective financial management, it's clear that proper setup of these groups and processes is vital. They form the backbone of reliable, transparent project accounting, enabling better decision-making and financial clarity. Let's talk about the importance of aligning your chart of accounts with your Subledgers. This alignment is crucial because it ensures that your financial tracking is both clear and precise. When your chart of accounts accurately reflects how your Subledgers are used, it makes reconciliation and reporting much more straightforward and reliable. Think of it as creating a roadmap that guides your financial data smoothly from transactions to reports. The benefits are significant: less confusion, fewer errors, and more confidence in your financial statements. So, when designing your chart of accounts, always keep in mind how it will be used in conjunction with your Subledgers. Proper alignment isn't just a best practice. It's a key factor in maintaining accurate and efficient financial management across your organization. Let's talk about best practices for naming conventions and data entry standards. First, it's important to group similar accounts together. This makes management much easier and helps enhance clarity and organization across your systems. When accounts are grouped logically, finding and working with them becomes a lot more straightforward. Next, avoid using special characters in your naming conventions. Special characters can cause compatibility issues and make data entry more cumbersome. Keeping names simple and consistent ensures they work smoothly across different platforms and users. Standardizing capitalization is also key. Consistent use of uppercase and lowercase letters helps maintain uniformity, reducing confusion and making your data look more professional. Inconsistent naming formats can lead to errors or misunderstandings, so sticking to a standard is essential. When naming accounts or data points, aim for names that are descriptive but concise. You want them to be clear enough to understand at a glance, but not overly long or complicated. Clarity is crucial to avoid any ambiguity. Maintaining data integrity is another vital aspect. Following consistent naming conventions helps ensure your data remains accurate and reliable over time. And using logical numbering systems can further support this by providing a clear, systematic way to organize accounts, making updates and audits much simpler. Overall, these practices are about making your data easier to manage, more consistent, and more reliable, integral parts of an efficient Subledger and posting group management system. Now, let's talk about how we can use dimensions to make our posting setup more flexible and easier to manage. By incorporating dimensions, we can reduce the complexity of our configuration, which in turn simplifies maintenance and helps us avoid errors. Using dimensions allows us to add extra layers of detail without multiplying the number of posting groups we need. This way, we keep our setup cleaner and more adaptable to changing business needs. Another key point is to avoid creating multiple posting groups that map to the same account numbers. This practice can lead to confusion and potential errors, making it harder to track and manage transactions accurately. Instead, focus on the best practices for simplifying your posting groups. Clear, Streamlined groups help maintain consistency and reduce the risk of mistakes, ultimately supporting a more efficient financial process. So, in summary, leveraging dimensions wisely and avoiding redundant posting groups are crucial steps toward a more flexible, manageable, and error-resistant posting setup. Now, let's talk about best practices for controlling direct posting, starting with permissions. It's essential to use permission sets to manage who has the ability to post directly. This helps us maintain data integrity and ensures our ledger balances are accurate. By controlling access, we reduce the risk of errors or unauthorized entries that could compromise our financial data. Next, we want to make sure that direct posting is turned off on account cards. Doing this prevents anyone from making accidental or unauthorized postings that could lead to reconciliation issues down the line. Essentially, by limiting who can post directly, we're creating a safer, more reliable environment for our financial data. So, the key takeaway here is that controlling direct posting through permissions and settings is vital for keeping our records accurate and avoiding unnecessary reconciliation problems. It's all about safeguarding the integrity of our financial information and making sure everything stays in balance. Now, let's take a closer look at the role of posting groups. They control the accounts where amounts from Subledger transactions are recorded, making sure that our financial data flows correctly and remains consistent across the system. This is crucial for maintaining accurate financial reports. Moving on to the purpose of posting groups, these define exactly how transactions in our subledgers are posted to the general ledger. They act as a bridge, ensuring that each transaction ends up in the right account, which helps us keep our accounting organized and reliable. So, what exactly are posting groups? They are essentially categories or classifications that determine the posting rules for different types of transactions. By setting these up properly, we streamline the posting process and reduce the risk of errors. And how do posting groups work in practice? When a transaction occurs in a subledger, the system checks the relevant posting group settings. Based on these, it automatically posts the transaction to the appropriate general ledger account. This automation not only saves time, but also enhances accuracy, allowing us to focus more on analyzing the data rather than managing it. Overall, understanding and managing posting groups is key to ensuring our financial data is accurate, consistent, and easily traceable through our accounting system. Now, let's talk about mapping Subledger data to the general ledger. This step is crucial because it ensures our financial reports are accurate and reliable. Essentially, it links the detailed transaction data we record in the subledgers with the correct ledger accounts. By doing this, we make sure that every transaction is reflected properly in our financial statements. Business Central makes this process straightforward by allowing us to directly map subledger data to general ledger accounts through posting groups. This means we can automate and streamline the process, reducing errors and saving time. The key takeaway here is that proper mapping is fundamental for accurate financial reporting, and Business Central provides the tools to make this both efficient and reliable. This connection between detailed transactions and the overall ledger is what keeps our financial data consistent and trustworthy. Creating specific posting groups for transactions is a crucial part of managing your financial data effectively. When you set up these groups, it simplifies troubleshooting because you can quickly identify where issues are occurring. It also clearly segregates transaction flows, making it easier to follow the path of each transaction through your system. This segregation is especially beneficial because it helps ensure accuracy in your financial reporting. By creating distinct posting groups for different transaction types, you reduce the risk of errors and make your reports more reliable. Overall, establishing these separate posting groups aligns with our goal of maintaining clear, organized, and accurate financial records. It's a key step in streamlining your accounting processes and ensuring everything is transparent and easy to manage. So, let's talk about some of the common issues that can arise between the subledger and the general ledger. These problems can really impact the accuracy and reliability of your financial reporting. One of the most frequent issues is incorrect posting group setups. When these are not configured properly, transactions can be posted to the wrong accounts, leading to misposted transactions, which can be confusing and hard to trace. Another typical problem is transactions in the subledgers that don't match up with what's recorded in the ledger. This misalignment can happen for various reasons, like data entry errors or timing discrepancies, and it's critical to identify and correct these to ensure your reports are accurate. Lastly, we often see out-of-balance subledgers, where the totals don't match the general ledger. This imbalance can be a sign of missing transactions or errors in posting, and it's essential to resolve these discrepancies to maintain financial integrity. Overall, addressing these issues is key to maintaining a clean, reliable financial system that supports effective decision-making. Now, let's talk about how to prevent and resolve subledger issues effectively. A key part of this is ensuring a comprehensive approach to managing both your subledger and posting groups. On this slide, you'll see that correct setup combined with ongoing monitoring is essential. When everything is configured properly from the start, it significantly reduces errors down the line and helps us maintain the integrity of our financial data. One of the first steps is to review your account mappings regularly. You want to make sure that your posting groups are set up correctly, because any misconfiguration here can lead to discrepancies later on. It's about double-checking that each account is mapped accurately to the right posting group. Next, it's crucial to reconcile your subledger data with the general ledger on a consistent basis. This isn't just a one-time activity. Regular reconciliation helps us catch and correct discrepancies early, before they turn into bigger issues. This continuous oversight keeps our financial reports accurate and reliable, which is ultimately what we all aim for. So, by combining correct initial setup with disciplined ongoing review and reconciliation, we can prevent many common issues and quickly resolve any that do arise. This approach supports the overall goal of accurate, trustworthy financial data across the organization. Now, let's talk about how to implement this control in Business Central. The key is to use permission sets to restrict who can make direct ledger postings. By doing this, we ensure only authorized users can perform these transactions, which adds a layer of security and control. Turning off direct posting isn't just about restriction, it also significantly reduces errors. When direct postings are turned off, transactions are funneled through subledgers first, giving us a chance to validate and review them before they hit the main ledger. This approach aligns perfectly with our overall goal of maintaining data integrity and improving financial accuracy. It might require some initial setup, but the benefits in terms of error reduction and control are well worth it. So, by implementing these permission controls properly, we can better manage our posting processes and safeguard our financial data effectively. Let's look at some practical troubleshooting techniques that can really help streamline your accounting processes. First, diagnosing posting discrepancies starts with reviewing transaction details in both your subledgers and your ledger. This step is crucial because it allows you to pinpoint exactly where the mismatch might be occurring. Next, it's important to check your posting group configurations. Sometimes, errors are simply due to incorrect or outdated setup, so verifying these can save a lot of time. Third, make a habit of reconciling balances regularly. This proactive approach helps catch discrepancies early before they become bigger issues. By following these steps, you can identify and resolve posting errors much more efficiently, ensuring your financial data remains accurate and trustworthy. These techniques are essential for maintaining the integrity of your financial reports and supporting overall business health. Regular reconciliation practices are essential to maintaining the accuracy of your financial data over time. By regularly reviewing and reconciling your subledger and posting groups, you can catch discrepancies early before they become bigger issues. This proactive approach helps ensure the integrity of your financial reports and keeps your data aligned. Using tools like ERP Connect Consulting's Health Check can be incredibly valuable. These tools allow you to assess your posting group setups and verify that your ledger is properly aligned. They provide insights into potential discrepancies and areas for improvement, making your reconciliation process more efficient and reliable. Ultimately, consistent use of assessment tools and reconciliation practices not only helps maintain accuracy, but also supports the overall health of your financial management system. It's an important part of ensuring your financial data is trustworthy and ready for decision-making. Now, let's talk about how these tools help us manage our project accounting more effectively. They enable us to capture detailed project financials, ensuring that everything is accurately reflected in the general ledger. This accuracy is crucial for making informed business decisions and maintaining financial integrity. Next, we focus on project posting groups. These groups are responsible for managing the posting of work in progress, costs, and sales related to our projects. They serve as the bridge between project activities and the overall financial records, making sure that each transaction is recorded in the right way. Understanding how project posting groups work is essential because they help us control and streamline our project financials. Proper setup and management of these groups ensure that our WIP, costs, and sales are correctly posted, giving us a clear picture of project profitability and progress. Overall, these components are vital for maintaining accurate, detailed project accounting, which ties back to our goal of having a transparent and reliable financial system. In this slide, we're focusing on setting up the bank account posting group, which is a crucial step in ensuring our bank transactions are accurately reflected in the general ledger. When we assign the correct posting group on the bank account card, we're making sure that each transaction posts to the right accounts, which is vital for effective cash management. This setup helps us maintain accurate financial records and provides a clear picture of our cash flow. Remember, assigning the right posting groups isn't just a technical step. It's about linking our bank activities seamlessly with our overall financial management. By doing this properly, we keep our financial data consistent and reliable, supporting better decision-making across the organization. Now, let's take a closer look at vendor posting group configuration. This step is crucial because it helps us keep track of payables more effectively and make sure that vendor transactions are posted correctly to the ledger. When we set up vendor posting groups, we're essentially creating a system to categorize our vendors in a way that aligns with our accounting processes. You do this by configuring the vendor posting groups directly on the vendor card. This allows us to classify vendors properly, which simplifies reporting and ensures accuracy in our financial data. Proper categorization is key here because it impacts how transactions are posted and how we interpret our payable data. So, to sum up, by carefully setting up these vendor posting groups, we facilitate smoother tracking of vendor transactions and improve the overall accuracy of our ledger postings. This step, while small, plays a big role in maintaining clean and reliable financial records, which is the backbone of effective financial management across the organization. Now, let's take a closer look at customer posting group settings. Proper configuration here is key to streamlining your collections, reporting, and reconciliation processes. When these settings are correctly set up, they significantly improve the efficiency of your overall financial management. Each customer posting group is mapped to specific accounts for receivables, revenue, and discounts. This mapping provides clarity in your financial reporting, making it easier to track and analyze your transactions. To categorize customers effectively, we use descriptive codes like domestic, INT-RCUMPANY, international, retail, and wholesale. These codes help you organize customers based on their characteristics or relationships, which simplifies management and reporting. Assigning a customer posting group on the customer card is a crucial step. It links each transaction to the correct account, ensuring your records stay accurate and consistent. This step is vital for maintaining reliable financial data over time. Customer posting groups play an essential role in receivables management. They define exactly how transactions with your customers are posted to the general ledger, whether it's for receivables, service charges, discounts, or fees. Overall, proper configuration of these groups helps you keep precise track of your receivables and supports smooth financial operations. It's all about making sure your financial data is accurate, organized, and easy to analyze. Now, let's take a closer look at the inventory posting group configuration. On this slide, we see that linking inventory posting groups with bank accounts and vendor or customer posting groups is crucial for ensuring a smooth transaction flow throughout the system. This integration helps us match transactions accurately to the right accounts, making our financial data more reliable. Next, we have the importance of assigning posting groups directly on item cards. Doing this guarantees that each transaction posts to the correct ledger accounts, which is vital for proper inventory valuation and calculating our cost of goods sold, or COGS. It keeps our financial statements accurate and up to date. Moving on to setup considerations, we need to define specific groups such as finished, raw materials, and resale. These groups help us differentiate between various inventory types, which is essential for accurate tracking and reporting. Finally, we see that defining inventory types through posting groups controls how different inventory categories, like raw materials, finished goods, and resale items, are accounted for in our ledger. This setup ensures that each inventory type is managed correctly within our financial system. Overall, the purpose of inventory posting groups is to streamline our inventory accounting processes, maintaining consistency and accuracy across all transactions. Now, let's look at how proper management really supports asset lifecycle reporting. When we manage our assets correctly, we ensure that our reporting accurately reflects each stage of the asset's life, from acquisition to disposal. This is crucial for clear and compliant financial statements. Supporting asset lifecycle reporting means we track gains and losses on disposal through designated accounts. This way, we can see exactly how assets are performing and when they are disposed of, giving us a precise picture of our asset management. To do this effectively, we need to be consistent with our account numbers, using, for example, the 12,210 series for acquisition costs and the 12,900 series for depreciation accounts. Consistency in account numbers helps us maintain clarity and accuracy across our records. Additionally, assigning fixed asset posting groups on each asset's fixed asset card is key. These groups help us map out the acquisition cost, accumulated depreciation, and disposal accounts systematically. This mapping ensures that our entries are correctly categorized and aligned with our accounting standards. All of these practices, proper management, tracking gains and losses, consistent account numbering, and correct assignment of posting groups, work together to support comprehensive, compliant asset lifecycle reporting. This ultimately helps us maintain transparency and accuracy in our financial reporting. Now, let's take a closer look at the general posting setup, which plays a crucial role in linking customers, vendors, and items within our financial system. This setup is designed to support complex scenarios, such as handling different posting groups for domestic versus international transactions or retail versus wholesale activities. By doing this, we can ensure that each transaction is categorized correctly based on its context, making our financial records more accurate and meaningful. One of the key benefits here is consistency. When sales revenue, purchase expenses, and inventory costs are recorded using established posting groups, we create a reliable and clear picture of our financial health over time. This consistency is vital for reporting, compliance, and strategic decision-making. Another important aspect is how transactions flow from Subledgers to the general ledger. We define this flow through mapping posting groups to specific GL accounts, which helps us automate and streamline our accounting processes. Essentially, this setup acts as a bridge, ensuring that every transaction lands in the right place within the broader financial system. The overall purpose of the general posting setup is to tie everything together, customer, vendor, and inventory posting groups, so that sales, purchases, and cost of goods sold are all recorded seamlessly and accurately. This integration helps us maintain a clear, organized, and efficient accounting process, supporting the overall goal of transparent and reliable financial management. Now, let's talk about analyzing Subledger balance checks. A key best practice here is to perform routine reconciliations regularly. Using tools like health check dashboards can really help us monitor the integrity of our data and catch issues early on. When it comes to reconciliation, it's important to understand common causes of imbalance. These often stem from incorrect posting group setups or sometimes from unauthorized direct postings. Recognizing these helps us prevent bigger problems down the line. Early identification of discrepancies is crucial. The sooner we spot differences, the easier and less costly it is to correct them. This proactive approach saves us time and avoids errors that could impact our financial reporting. One effective way to do this is by comparing balances across different subledgers, such as accounts receivable, accounts payable, bank accounts, inventory, and fixed assets, with our general ledger. These comparisons are vital for ensuring accuracy. In summary, regular subledger to general ledger balance checks are essential. They are a cornerstone of maintaining the overall financial accuracy and integrity of our records, aligning with our goal of sound financial management. Let's take a closer look at some common posting group codes and what they represent. For example, you might see codes like equipment, goodwill, plant, property, or vehicles. Each of these codes links to specific general ledger accounts that handle receivables, payables, revenue, expenses, and asset tracking. This helps ensure everything is properly categorized and organized. Now, when we talk about fixed asset posting groups, you'll often see examples like finished, raw materials, or resale. These groups help us distinguish between different types of fixed assets, making tracking and reporting much clearer. Similarly, inventory posting groups include labels like domestic, which might be associated with account number 22,100, and international, linked to 22,200. These groupings help us manage inventory across different markets or regions efficiently. For vendor posting groups, you'll find categories such as domestic, with a code like 15,110, INTRC1PNY at 15,112, international at 15,120, retail at 15,135, and wholesale at 15,136. These codes streamline our vendor management and ensure transactions are properly allocated. Customer posting groups are just as important. Understanding these frequently used posting group codes helps us maintain clarity and consistency across our financial data. So, what's the main purpose of these posting group codes? Essentially, they serve to organize and simplify our accounting processes. By linking transactions to specific groups, we can automate and standardize our reporting, ensuring accuracy and efficiency throughout our financial management system. Let's talk about avoiding duplicate account numbers in posting groups. One effective way to do this is by turning off direct posting on account cards. This forces users to use posting groups, which makes the data more consistent and easier to reconcile later on. When we do this, it simplifies the reconciliation process and really boosts data integrity. Now, to enforce posting group usage effectively, I recommend grouping similar accounts together and standardizing your nomming conventions. Consistent nomming helps everyone understand what each account is for and reduces confusion. It's also important to maintain a clear and logical numbering system for your accounts. This makes it easier to find and manage accounts over time. Instead of creating multiple posting groups with the same account numbers, which can lead to confusion and reporting errors, consider using dimensions to differentiate transactions. Dimensions allow us to add context without duplicating account numbers, which keeps things cleaner and clearer. Ultimately, creating multiple posting groups with identical account numbers can cause a lot of confusion and lead to errors when generating reports. By following these practices, we can ensure a more organized, accurate, and efficient approach to managing our posting groups and accounts. Now, let's look at how using dimensions can really simplify our posting group structure. As part of our comprehensive guide to Subledger and posting group management, this is a key concept. Leveraging dimensions helps streamline our accounting processes and enhances our ability to gain better financial insights. By incorporating dimensions, we can reduce the complexity we often face with a large chart of accounts and the need to set up numerous posting groups. This approach enables us to be much more flexible in reporting. Instead of creating multiple posting groups for different categories, we can tag transactions with attributes like department, project, or region. This makes our reporting more dynamic and adaptable to various analysis needs. Furthermore, dimensions allow us to perform detailed transaction analysis without multiplying our posting groups. It's a more efficient way to get granular insights without cluttering our setup. In essence, dimensions offer a powerful alternative to creating an overwhelming number of posting groups. They keep our structure cleaner and more manageable, while still providing the depth of analysis we need. Overall, by integrating dimensions into our processes, we're making our accounting system more flexible, less complex, and more insightful, helping us make better, more informed decisions. Let's wrap up with some final recommendations and a quick summary. Throughout this presentation, we've emphasized the importance of managing your subledgers and posting groups effectively to ensure accurate and reliable financial data. One key point is to utilize tools like health check dashboards. These are invaluable for proactive financial monitoring, allowing you to catch issues early before they escalate. Next, leverage dimensions and consider disabling direct postings when appropriate. This helps prevent duplicate account numbers, which can cause confusion and errors down the line. Regular reconciliations between your subledgers and the general ledger are also crucial. They help you identify and resolve discrepancies promptly, keeping your books aligned. Maintaining clarity is vital, so use consistent naming conventions and logical numbering systems. This makes your data easier to understand and audit. Finally, take the time to carefully set up your posting groups for different areas like customers, vendors, inventory, fixed assets, and projects. Proper configuration here ensures smooth and accurate posting processes. Altogether, these best practices form a comprehensive guide to subledger and posting group management. They're designed to help you maintain clean, accurate, and transparent financial records, which are the foundation of sound financial management.